I talked last week about the market statistics, and it was interesting because there's a lot of contradiction in the statistics for our real estate market. And the reason why there are so many contradictions, and when I say a contradiction, I mean something like a segment of the marketplace not operating like the rest of the marketplace, or our real estate market not performing at the same level as, stats that you're seeing national. Either that's better or worse than. And so I want to explain what's happened in our market that's caused this kind of segmentation more so than any other time in my entire real estate career. And the very first thing happened a few years ago. We had a condo building collapse in Miami. And that began almost a wave of new regulations, insurance requirements, and changes in condo buildings, a condo market that was already kind of on fragile ground, and caused HOA fees to rise and buildings to become less valued and people to be more skeptical of buying condos because of the possibilities of some of those challenges costing them money. So what started then and has continued through to today because of, compounding from floods that we had and hurricanes, our condo market is, for the most part, except when you get into the uber luxury side of it, our condo market is very weak. So the condo market is very saturated. It is, for all intents and purposes, the buyer's market for most condos. Those affordable condos that have a hard time affording or weren't built up to standards have had to go through extra construction requirements to bring them up to speed and allow them to continue operating, and those have costs that they've passed on to owners, which is depressed values and depressed demand. And when you get reduced demand and more supply, what happens? The market gets worse. So our condo market the last few years has continued to get worse. And so, the single family market, on the other hand, isn't as bad. So when you see our average sale prices and you see things like, hey, prices are down or prices are up, it can be misleading because they may be down or up depending on the type of product that you have. And right now we have a very significant separation. There's always been a separation. Condos have never performed as well, single family, but performed much closer in prior stages of my real estate career than they do now. Presently, condos are performing bad. They just are. So you have this situation where the average is being drugged down by condos. And so people look at that and they say, okay, well, the market's not great. You're seeing depreciation. And then they think everything's depreciating. And that couldn't be further from the truth. So that's a segment of our marketplace that's causing a disparity in the statistics. It's confusing people. The second disparity that I would say that's being caused in our market that is skewing the data is the luxury market. Let's say above $1 million, or even in some parts of Tampa Bay, $1 million is average, maybe above $2 million. And we're seeing more activity in the high end and, more people moving here from other states that don't have, have worse tax setups for entrepreneurs and wealthy people. We're seeing, we had a couple of years of no hurricanes, so that's not on people's mind as much anymore for those beautiful waterfront high-end homes. And so that's pulling averages up. So while the condo market is pulling it in the other direction, the luxury market is offsetting it. So we have this situation where, a lot of the condos, and specifically the lower priced ones, are depreciating. We have the luxury market where properties are appreciating, where we're seeing homes selling for more money. We're seeing, I think, in fact, a few months ago, there was an article that said that Tampa Bay was number one in the country for increase in luxury prices. And I continue to see it across my feed. And when I look at the statistics, how many luxury properties are coming on the market and what is happening with the luxury market. So we're continuing to see that. You're seeing these tax policies in California and these policies in New York move people to Florida. Now, Miami is probably the instant hot spot for a lot of that, but there are plenty of people who are going down to Miami and saying, let me look at Tampa, and deciding to go to Tampa because maybe it's more affordable, or maybe it's less congested, maybe it's more family friendly than Miami. So we're getting that extra, push from that audience. So the luxury market is, pulling things in the opposite direction. And then you have the, kind of the core, the middle. And the core in the middle is probably more unchanged than anything else. the last several years in terms of price. So, I have, clients and friends and family that bought new construction anywhere from 22 to 24 that now decide, hey, I want to sell. And they didn't lose value, but they didn't gain value either. Or maybe they lost a little bit or gained a little bit, but not enough to make selling it get them out of their mortgage. So a lot of the condo owners aren't in the financial distress because a lot of those are second or vacation or retirees that have, substantial finances. Whereas the intro new construction home crowd, we're starting to see foreclosures happen and short sales happen because those people bought. The builders are still building in those communities, and they're now having to move or not able to afford it or losing a job or whatever it is, and they're unable to sell without either writing a check or doing a short sale. So that's why our market right now is in such a weird place. It's hard for people to understand because it really depends on the segmentation of it. So if you want to know what's going on in your neighborhood, and look, when I say this, we cover a really broad geographic area. Does this mean that what I talked about is exactly going on in your community? Maybe you're in a condo building that's doing incredibly well. Or maybe you're in a new construction community, the builder's done building and homes are appreciating and you can sell. So these are generalities that unfortunately don't apply to every single asset in the market. No different than, a day where we say, hey, the stock market's way up, but technically 10% of the stocks were down that day. But the overall market was up. It's the same thing in real estate. It's just really segmented now more than it's ever been. But if you want to know what's going on in your neighborhood, just go to duncanduo.com. You can fill out a quick, very easy report to see your home value. You can see what's going on around yours. You can see, are these trends that I've talked about happening in your neighborhood? Again, that's duncanduo.com. You get your free home value report. You can request an instant cash offer. You can set an appointment with our team. You can also chat and text with our AI agent to help you understand your value, help you improve your value, and so much more. Again, that is on duncanduo.com. So again, basically just three different segments in the market right now. We've got condos and multifamily. We've got single family homes at the core. Then you've got, the luxury market. And, within that single family home core, a lot of the people are disadvantaged right now. Are disadvantaged because they're selling maybe a new construction home that the builder's still building in there and you can't compete with the incentives and your value hasn't risen, but it hasn't dropped, but the selling fees make it impossible for you to sell and get out. So that is exactly what's going on. We've been hoping for interest rate relief. It's hard to say if it ever comes. A lot of people predict that it will not. Until potentially next year or maybe even the year following. So we're in the market we're going to be in. If you've been waiting on interest rates to drop, you might wait till it's too late. It may not show up.